Okay, welcome everyone, and the topic for discussion today is Chapter 6, Risk, Return, and Capital Asset Pricing Model. So this chapter will be focusing on, bringing together the ideas of expected return and risk. We discussed about that expected returns are in relation to the risk that you take for any sort of asset or investment. Now, what basic premise or how can you use these concepts to come up with a sort of a linear line that decides the relationship between expected return and risk? And be mindful that I use the term expected return because it's not guaranteed. The return is not guaranteed, it's expected. So we will try to understand this relationship in discussing in this chapter this evening. You would have to apologize my speech today because I'm still under the weather, and I'll try to do my best for the lecture today. So the basic topics for discussion today would be to understand the basic return concepts, the risk concepts, standalone risk, market portfolio risk, and the capital asset pricing model and the securities market line. So again, remember, in the whole concept of the semester, we've been looking at this basic relationship, that is the value, which is the current value of any asset, is dependent on the future cash flows that you get from the asset, divided by some concept of risk, or discount factor, or in this case, the weighted average cost of capital. So that risk is really associated with the probability that these future cash flows will not meet. So higher the risk on any asset or component will have an impact on the valuation of that asset. So it's important to understand this relationship. That is how you should pick assets for portfolio construction if you have understanding of the expected return and risk. So what are investment returns? Let's first try to understand what are investment returns. Investment returns measure the financial returns or results of an investment. Now, returns may be historic or prospective, that is anticipated. Historic means if this is today, you basically look at the historic data. Anticipated would have been an expectation because they have not happened. So the best you can do is make an assessment. Now, returns can be expressed in dollar terms or percentage terms. So just to give you a differentiation, let's take a simple example. An investment costs $1,000 and is sold after 1 year for $1,100. So in terms of dollar return, you received $1,100 less 1,000 that you invested, so your investment return is $100. Now, in case of percentage return, your total net return is 100 divided by your investment, which is 0.10. That's equal to 10%. So either way, either you express in dollar terms or percentage terms, you could express your returns. Now, this is a positive return. In some instances, you could have a negative return. For example, if you only received 900 and you invested 1,000, your dollar return would be what? Minus 100. And same thing in percentage return, it would be $100 minus divided by 1,000. That would be equal to minus 10%. That is a capital loss. So it can be either way. So what is investment risk? Like I just mentioned, typically investment returns are not known with certainty. I mean, if I had a magic ball to look into the future with guarantee, I wouldn't be teaching here, right? I could just sit and invest and know for certainty, what is going to be the outcome and sell on that particular date. It's like, those movies, Back to the Future, you go to the future, get that, the game book, right? And you bring it to the past and then you could make money like that by betting. But fortunately, unfortunately, what's going to happen in future is unknown, and that's the reason why we cannot say it with certainty. Investment risk pertains to probability of earning a return less than that expected. So different textbooks will have a different definition for this risk. In this one, it's mentioned the probability of earning return less than that expected. In certain textbooks, it's simply mentioned as the probability that the future cash flows will not meet as expected. It could be either way. It could be higher also. So is that a risk? If you get more than what you were expecting, is that a risk? Well, could be, because it's a volatile market. Analysts will take that as a risk because it's volatile. Even though it's in your favor, it still is volatile. The greater the chance of a return far below the expected return, the greater the risk. We've already seen that goes into this relationship of present value equals future cash flow divided by 1 plus r raised to the power p. So greater this discount factor, lower would be the expected return, coming into the future. So let's take this simple graphical representation, probability distribution. Probability distribution means these are the expected returns of two stocks. The green one is stock B, red one is stock A, and you can see the probability distribution of the returns of the two stocks. So let's look at this and say which one is riskier. So let me ask students online and in class, which one do you think is riskier and why?
It would be A because of how much it peaks and then this drops down so much sharply, where B looks like.
But the peaks are not pertaining to the returns. I mean, look at, so it'll be B.
Just because of how the spread is.
Exactly. So this now you said the right answer. This is, look at the band. If this is the average, if 15 is the average, the volatility is happening very narrow to the band.
Okay.
But look at stock B. It's much wider, right?
That's just because it's spread.
It's spread out, so you can't say with certainty what the exact outcomes are going to be.
So I see, because A is more consistent.
Exactly.
Okay.
If it's going to be,
Yeah, I see what you're talking about.
so if it's more consistent, it's less volatile.
Okay.
If it's just much wider, it's going to be more volatile. So for example, a T-bill, the outcome of a T-bill in terms of returns is going to be more precise, because you know that it's much safer to invest in a T-bill. The returns are going to be very predictable. Whereas if you invest in a stock of a company, it could be very volatile. It may not be
You don't know
what the future might hold for the returns of the stock. So students online, everyone clear with this explanation? So, okay, so let's take this example, and I think the best way to really work this example is if I help you or take you step by step using Excel. So if you have a PowerPoint printed, keep that in front of you, or I'll just speak out as I fill out the information. So the first thing I'm going to do is I'm going to fill out this information in Excel, and that may take a minute or so. Yes.
I'm just going to print the slides now. I think switch classes. The slides that you posted in our class weren't on material.
Really?
I'm hoping they weren't.
Okay. My mistake, you know.
Hey, you're a little bit sick, it's fine.
Yeah, so I'm going to go back and check. Yeah. I like to be superhuman, but you know, I'm just a human. Let me just open up Excel. It's there. So students online, let me just start sharing it. Okay, students online, can you view the Excel worksheet that I've shared? So the Excel worksheet that I'm going to create is simply going to provide a probability of returns for various investments in different types of economic conditions. So this is economic condition. Economic condition means economic conditions of the economy. So let's be consistent with that. Let me just. The Excel has just stopped responding. I'll give it a minute. Okay, now it's come back. Yes, my Excel works with me. A little, yeah. And now I have the probability of returns. And then we have different investments. There's T-bill, company called Alta, Repo, AM Home, I think it is, and then MP, which is market portfolio. Now, we got different economic conditions. One is bust, which is like total market collapse. There is below average. There is average. And this in terms of economic conditions, you know, economic performance of the market, above average, and then boom. By the way, what would you classify current market condition? Below average? That's very pessimistic. So there's a 10% probability or chance that, you know, the market will perform in a bust situation. There's a 20% probability it will be below average. There's a 40% chance of average. Above average is 20%. And then finally, we have boom, which is 10%. Okay? One thing about probability is what? That the total of all probabilities has to add to 100% or 1. So this is something that you should remember. Okay, for T-bill, the returns is going to be 8% irrespective of any type of market condition. Why is that? Irrespective of any type of market condition, it's guaranteed. First of all, it's a bond with fixed coupon payment, and is guaranteed and backed by the U.S. Treasury, that is, you know, the U.S. government. So the probability of its default are close to zero. So almost zero risk. Now in terms of Alta, it has a 22%, I mean it's going to drop 22% in return if there's a bust situation. So your returns are going to be negative 22%. For below average, it's negative 2. For average, it's 20% of return. For above average is 35. And for boom, it's 50%. Okay, everyone clear with that? Students online? And then you have repo, which is 28% in bust. Below average is 14.7. Average is 0. Below average is negative 10. And then boom is negative 20. Then AM Foam, which is another company, in bust it's 10% return. Below average is 10%, negative 10%, average is 7, above average is 45, and then boom is 30. And then the market portfolio, which is taking the entire market, is negative 13% in bust. Below average is 1, average is 15. Above average is 29, and then boom is 43. So, what can you say about these companies? I mean, T-bill we discussed. What about Alta?
Pretty bad.
Well, overall, if you look,
Oh, high risk, honestly.
really,
Also,
Alta, it's moving with the market, right?
very volatile.
It's moving with the market. When market is not doing well, it's not doing too well.
Right.
But when the market is doing well, it does well. Look at the 50% return. It's the highest return that you can get if the market is really doing in the boom situation. What about repo? It's the other way around. It's inversely related with the market condition. When the market is not performing, repo is doing well. Do we have examples of such companies? Yes, we do. Look at all the Dollar General type stores. They did phenomenally well when we had financial crisis. So they seem to be inversely related to overall market conditions, because consumers become really conscious about spending when market conditions are not good. When market is in the boom cycle, money seems to be flowing in. It means that there's full employment in the economy, people have money, and the money is being spent. So you'll find more companies which are, brand name companies, or where consumers go and spend more money. They'll be performing well when the market is doing well. So these are the kind of relationships that you should now start looking at when you look at such tables. Then we have an overall market portfolio, which really is, again, combination of all the stocks in the market, just to give you a reference. So we've already discussed what is unique about T-bill return. The T-bill will return 8% regardless of the state of economy. That is an advantage of investing in a bond, that it's a commitment which will give you a fixed coupon payment that has been promised to you, irrespective of what condition the market is. Company or government will have to pay you that return. Is the T-bill riskless? Nothing is riskless, but the kind of risk that is associated with it is almost zero, because it's backed by the US Treasury, which has never defaulted on its commitment historically. Okay, so the next slide says Alta Industry and Repomen versus the economy. And we have seen that Alta Industry moves with the economy, so it's positively correlated with the economy. This is typical situation. But Repomen is a sort of a unique find because it moves counter to the economy. Such negative correlation is unusual. Most companies you'll find would move with the economy, like, Alta. But repo is unusual but not out of the ordinary. You may find one. So if you can add companies or assets which move counter to the market in your portfolio, that may insulate your portfolio from investment risks. For example, when there are sudden drops in the market, like we just had, 3 months back, when the Dow Jones dropped, 1,000 points or 1,500 points. Now that came as a surprise, and people were talking about it, but it came as a surprise. And if you had a variety of investments in a portfolio, at least the risks are mitigated. They're not eliminated, but they are reduced, and I'll show you how. So the first thing is how to calculate the expected return of each alternative. So let's calculate the expected return for So the way you do it is you'll take the probability weight and multiply that with the expected return for that probability, and you add all of them. I'll show you how to do it. So for example, in case of the bust, what is the probability? 10%. Multiply that with the return of T-bill, that is 8, right? So add all of them. So the next one is 20% multiplied with 8 plus 40% multiplied with 8 plus 20% multiplied with 8 plus 10% multiplied with 8. So what should be the answer? 8. Why is it 8? Because you're simply multiplying 8 by 1, which is the total, right? So that's 8. That means your expected return in this case is going to be 8%. That is its advantage of investing in a bond. Same thing with Alta. Let's see what the thing would be. It would be 10% multiplied with let me see if I can just copy across. Okay, that would work if I had put dollar signs here. So what I'm doing is I'm anchoring the references to the probability, because that thing is going to be stationary, the other things can move. It should now work. Yeah, this 17.4, this is 1.74, and this is 13.8, and then market is 15. So the expected return, Alta is 17.4%, repo is 1.74%, American Form is 13.8%, and market is 15%. So which company provides the best expected return? Alta, right? Is this the best company to invest in? Is this the best asset to invest in? It's got the highest expected return, but that's half the story. We still have to find which one has the highest risk. because this is expected return, not historic return. So what is the risk that we will not receive this expected return? That we have to do by calculating the expected return. So, I'm sorry, by the risk, which is going to be standard deviation. So standard deviation is going to be calculated by taking the unit value, which is going to be 8, for example, minus the mean, which is 8, squared. Why do you square in standard deviation?
Because we have to get it under root. It's actually under root. We are taking the rate. And we have to take a value.
No, that's not why we do square. Because standard deviation measures what? Risk, right? So it could be positive or negative. The reason why we do square is to eliminate the negative portion of it, because we are simply interested in getting the deviation away from the mean. It could be up or minus. And the square root we do is to eliminate the square that we did. So that is a two-step process. So remember, if somebody asks you this question during a job interview, if you're especially interested in investments type jobs, they might ask you, why do you do that? Because, like I mentioned, another trick question they will ask is, why should we be assuming the positive territory as a risk? It should only be the negative. So what's going to be your answer? For example, if you're expecting 15% return and you're getting 20% return, why should you be bothered? It's good. Why would you treat that as a risk?
It's going to add more volatility.
Exactly, because in investments on or long term, you are not really concerned about the return as much as the volatility. Volatility is more of a problem to your portfolio than the return. Okay? It may be a little hard concept to accept right now, but as you do more chapters, when we come to options, then it will become even more clearer why that is important. Okay? So, students online, are you all clear with this explanation? All right, so let's calculate the one for T-bill. I mean, T-bill, I know the risk is 0%, so just going to put 0 because there is no risk. There is. I mean, 8 minus 8 is going to be 0, so why calculate all that? Let's do for Alta, which is going to be 22 minus its expected return. So I'll put $1 here, and this raised to the power 2, and this multiplied with the probability plus the next one, which is -2 minus, again, it's okay, this should be $1 here, not the other one. Raised to the power 2 and multiplied with its probability, and then should take 20 minus 17.4 and then raised to the power 2 multiplied with its probability, and then you have 35 minus 17.4, a dollar here again, raised to the power 2 multiplied with its probability plus 50 minus 17.4 raised to the power 2 multiplied with its probability, and then the whole thing okay, just have to square root this, so I'll just put it here, which is 20 point this thing, so I'll just carry it down here. So the first one, you can just take it as variance. Standard deviation is square root of the variance. So, this is the variance, this is standard deviation. Okay, something went wrong. So this is E2 minus E9 raised to the power 2 multiplied by C2. Okay, so this is gone wrong. All right, so not a problem. Just have to put dollar signs here. Students online, what I'm doing is I'm anchoring the references, because remember, for each of those calculations, the probability column has to be the same, so now it's correct. All right, now exactly. This is exactly as in the PowerPoint. So let me reduce the number of. Okay, here we go. So in this case now, which stock has the highest risk? Alta has the highest risk, right? Students online, can you see this? So my question now is, which would be a better investment? Which one would be a better investment? Well, we can calculate and find out. Let me go back to the PowerPoint so I can explain some of the other concepts. So we'll come back to the Excel. So we just did this, and the T-bill. Remember, we discussed about what is unique about the T-bill, and we discussed how these stocks are comparing with the overall economy. And this is the calculation we did for the expected return. This is the example for Alta, which was 17.4. This is the formula for expected return. Remember, this hat is estimate. You always put a hat for estimate, because you are providing an approximation expectation. So this is what we calculated, the expected return. Alta has the highest rate of return, which we discussed. So does it make it the best? Well, that's only half the answer. Half will come from looking at the amount of risk associated with this return. And that we found by calculating the standard deviation. Remember, standard deviation is square root of the variance. Sigma square is the variance, square root that, and that's standard deviation. And again, the reason what is variance is, if this is the mean line, actual returns are somewhere here, so the deviation away from the mean is what's of concern to us as investment. So to provide that with one number, looking at the deviation away from the mean, is this standard deviation, which will give you the number. So in this case, the higher the standard deviation means what? Higher or lower risk? Higher the risk, because that's going to be, on average, more volatile, that is away from the mean, right? That's the concept. So then we equate, then we calculate the standard deviation, which I just did, and this raised to the power half is square root. This is simply square root. So finally we got this standard deviation calculations, and we observe that Alta has the highest risk. So it does have the highest expected return, but it also has the highest risk. So how can you get one number to standardize your return versus risk, so that you can really compare your investments? And that is done by looking at the standalone risk, which was, we just did standard deviation measures the standalone risk of investment. The larger the standard deviation, the higher the probability that the returns will be far below the expected return. Okay? So this is the chart to compare expected return and risk. And this is what will really tell you which investment to pick, which is coefficient of variation. Now, coefficient of variation is standard deviation divided by expected return. So simply speaking, this is the amount of risk that you take for per unit return. If you have to provide a managerial implication, this is the per unit, this is the amount of risk that you take for the per unit return. Okay? So let's go back to our Excel sheet to calculate our coefficient of variation. So coefficient of variation in case of T-bill is simply going to be 0 by 8, that's 0. And then for Alta is 1.15, and then it's a little bit different than PowerPoint because, of the precision, but if I reduce the number of numbers, it's still 1.2 because I think what they've done is they've literally taken the 20 divided by 17.4. But nevertheless, now you get a clear understanding of where your investment should be. Look at your investment pattern. You got T-bill, where your amount of risk for unit return is what? 0. You're not taking any risk at all. What about Alta? You're taking 1.2. So you're taking 1.2, about 20% more risk for 1 unit of return. What about repo? 7.7. It's too much, right? You're taking 7.7 units of risk to get 1 unit of return.
This is versus the market portfolio, right?
Yeah, market portfolio is giving exactly 1.
Right.
and then AMF is 1.4. So looking at this chart, which should be your investment decision? Where do you think you should invest? Well, there is one which is T-bill, which is not going to give you enough return, or there is market portfolio, which is one. Many people nowadays say, we don't worry about picking stocks, we don't worry about picking this sector. All they do is just invest in index traded fund, which is linked to the market, and they get what the market return is, and that's pretty good. In this case, you're taking one unit of risk for 1 unit of return, but is it effective? No, because you're not getting anything more or less than what you should be getting. In case of Alta, 1.2, so you're taking a little bit more risk, but you're getting a higher return. So this can be well explained in the graph. So this is exactly what we had in our Excel sheet. And the coefficient of variation, this is the one. So look at this graph. Now, return versus risk, standard deviation, which investment is the best? So if you were to, let's say, draw a straight line, let me see if I can do that. This is the securities market line, which gives a relationship between return and standard deviation. T-bill is the starting point because that's zero risk and you get 8% return. Market return is going to be exactly on the securities market line, which is going to be 1. Coefficient of variation. Alta is less because remember you were taking 1.2 units of risk to get 1 unit of return, so it's a little bit less. AMF form is even less. Repo is, look, how much of risk. So if you had to construct a portfolio, which stocks, which investments would you pick? T-bill, market portfolio, and Alta, right? Because AMF form, even though you get return, but your risk to return ratio is not in your favor. Students online, is it clear to everyone? Okay, so let's move to another interesting concept, that is, can you reduce the risk of your portfolio by combining different type of stocks or different type of assets? So we're taking this example of, assume a 2-stock portfolio with $50,000 in Alta Industry and $50,000 in Repoman. So you calculate the expected return of the portfolio and the standard deviation of the portfolio. So let's see how we can do that. Now, the expected return of portfolio is the weighted average. Weighted average means the weight of one stock plus weight of the other stock, which comprises of the portfolio. So in this case, it's what, 50%, right? So equally divided. So what we can do is, to get the expected return of the portfolio, we can individually take expected returns of these two companies. What was the expected return of, because in this one we have Alta and Repoman. So let me show you, calculate the expected return here. So Alta is 17.4 and Repomen is 1.7. So it will be 50% multiplied by 17.4 plus 50% multiplied with 1.7, right? That's going to give you a so there you go, 50% of 17.4 plus 50% of 1.7%, that's going to give you 9.6%. That's the expected return of the portfolio, not individual stocks. So combined, your expected return has dropped. Do you see this? Individually it was 17.4. So if you combine the other company, the expected return has dropped. Let's see what happens to the standard deviation. And this is, another way of doing portfolio. This is like taking individually the companies and then doing this portfolio 50-50. Like we did for individual, you can do 50% of this and 50% of that and add. But the easier way is to just do like this, This is a much easier way to do it, right? So let's calculate the standard deviation. Standard deviation would be 3 minus 9.6. If we get that 50% of both, and we can calculate that, let me just do that. So let's go back to Excel to calculate this. So this is portfolio, which is 50% Alta plus 50% repo. So this is going to be, you can just add the two, Alta plus repo, and then divide that by 2. So it's going to give you that average. Okay, and this is now same as what we have in the PowerPoint. Now we can calculate the expected return. I can just pull it across, and this is 9.6 for this. And then the variance for this will be 11.1. Standard deviation is going to be 3.3. And what happens to the coefficient of variation? 0.3. So you see the magic? What's the magic? You're getting a higher return and you get a lower risk. So the coefficient of variation is 0.3. Huh?
You're taking risk, but it's really less. So you're just getting volatility out of it.
You can, when you add stocks which are of different characteristics in your portfolio, you can reduce the risk of your portfolio. So how is that coming to reduce the risk of the portfolio? Is because of different volatilities that you're bringing in. As one stock goes up, the other will come down a little. If the other goes up, other will come down a little. On average, it will reduce your risk. So that is one. Exactly. You're trying to narrow that band by adding different type of stocks in your portfolio.
Okay.
And that's mathematically proven now. Right?
To a certain point though, right?
The idea is to bring it as close as possible. You know, you cannot really have a zero coefficient of variation. That would be the case of T-bill.
Right.
But if you had to take some risk, that would be to add more assets to your portfolio which are of different type. Students online, does that make sense, everyone? This is the important part, you know. You have reduced the coefficient of variation, which is the amount of risk that you're taking to get 1 unit of return. So look at the comparison. In case of Alta individually, you have to take 1.2. In case of repo, you have to take 7.7. But when you combine together in a portfolio, you take 0.3. That's investment magic, right? You just put some stuff in there, and boom, you get investment magic. Yeah. Okay, so let's. So this is it's one of the most important concepts in investments. You know, this portfolio construction and reducing the risk of the portfolio by combining assets which have a different characteristics. Now, if I combine, let's say if I construct an asset with Intel, Apple, Microsoft, similar industries, will I be able to reduce the risk as much?
I think the composite will be the same.
Not really, because they are the similar industries. You know, they'll have similar risk and different type of economic conditions. So yes, there will be some reduction of risk, but not as much. But if I put,
But typically you wouldn't be, I guess considering what we're talking about, you wouldn't be putting, I guess for the sake of this example, you wouldn't be putting such opposite investments in a growth portfolio. I mean, I understand for example.
well, yes, you will not see. It depends on your goal.
Right. Yeah.
I mean, you look at the linear relationship. I mean, it's simple. You know, you got a starting point and linearity that takes return and risk. I mean, this is going to be, yes, return and risk. So to get a higher return, you will have to take the higher risk. So growth portfolio will have generally a higher coefficient of variation. You know, there is no free lunch, as they say. I mean, you can't expect to invest in T-bill and expect 30% return portfolio. So the idea here is when you add more investments which are different in characteristics, you are able to mitigate your risk to your portfolio. And these are for long-term investments. You know, in discussion with colleagues, you know, I found that with the recent fallback in Dow Jones Industrial Average 3 months back, several of them lost maybe 15%, 10% in their investment portfolio. Why? Because they were concentrated in one or two different types of companies or stocks. But when you add different type of companies and stocks, that drop becomes low. Your growth will not be as high as well, but your drop will not be as much as well. So it depends on what your ultimate goal is. So this is, yes.
Can you just go to the back? For the first case, how will you get 3%?
3% is you take 50% of Alta. I'm sorry, you take 22 plus 28 divided by 2 because 50-50. That's the average. So it's, this is 0.34. This is your coefficient of variation. So portfolio expected return 9.6% is between Alta 17.4 and Repo 1.7 returns. Portfolio standard deviation is much lower than the standard deviation that's given. The reason is due to negative correlation between Alta and Repo return. So this is, a case of two-stock portfolio. Two stocks can be combined to form a riskless portfolio if the correlation is -1. This is if you find two stocks which will never be correlated. One moves up, the other will exactly move down in the same intensity. Risk is not reduced at all if two stocks have correlation which is +1, which is, like putting two companies which are exactly together, like maybe Ford and GM. If you put together in a portfolio, they're almost similar companies. They'll always move up and down together. In general, stocks have a correlation of 0.35, so risk is lowered but not eliminated, that we've been discussing. Now, how can you really even reduce this portfolio risk? Add more stocks from other countries. How does it work? You got a market risk, you got firm level risk, you have sectoral risk, you got country risk. So you can mitigate that by investing in other countries. So this can be even further brought down by investing in two different countries. Because market risk of the US stock market is not going to be the same as the market risk of, let's say, Russia or India or China or some other country. So global investments can even further reduce your portfolio risk. Investors typically hold many stocks. What happens when the correlation is 0? What happens when correlation is 0? Correlation. That is the intensity of how the two variables will move together. When it's 1, that means they're exactly moving, +1, they're exactly moving in the same direction at the same intensity. When it's negative, it's exactly moving in the other direction. When 0 is random, you cannot really say anything because there is no relation with each other. Anything that happens is no relation. It may or may not happen. They have absolutely no relation to each other.
Negative correlate or positive.
You cannot say. It could happen. It'll just happen without any relation to each other. For example, I don't know. All the stocks in the entire world market are somehow related to each other these days, but this is a theoretical case of two stocks absolutely have no relation to each other, which is virtually, this is a theoretical case. They may be, because even though, let's say if I invest in a stock in India, but the markets are somehow connected, so there will be some relation between likelihood the other market is impacted. Virtually now no market is insulated from foreign shocks. So you cannot, this would be the case where, for example, isolated country which has got no relation, like North Korea, I don't know if they have any. Even if that, they would still be related with our world market somehow. Stock in? Yeah, on the moon, exactly. That's what I was thinking, maybe stock in some other planet. Yeah. Maybe they're still related somehow, I don't know. They're tracking world markets. Yeah. Well, again, since this is theoretical, we can provide any theory. That's the advantage. Yeah, I don't have to prove. adding stock to a portfolio, what would happen to risk of average one stock portfolio as more randomly selected stocks are added? One stock, for example, if you put all your money in Apple stock, that's your entire portfolio. How would your portfolio perform when Apple is doing great? You'll be making a lot of money, but what happened if Apple suddenly started going down? Your risk will also be the same. This is exactly what most investors did in the tech bubble crash. What were they doing? I knew of a lot of people who were investing in just one or two companies or IT companies, that's it. Their portfolio, the entire portfolio was one or two companies, and that to IT companies, and that's it. And what happened when the tech bubble burst? Their portfolio was totally crashed out. So this is a good learning lesson on personal level for everyone to manage your portfolio, which is diversified. So here's a graphical representation of portfolio with one stock could be sustainable, could be facing a 35% risk. When you add many stocks, for example, two stocks, look at the kind of mean standard deviation that's reduced. And then many stocks would reduce even further. So look at the kind of, one stock is so wide, and then two stocks reduce a little bit, and then many stocks reduce even further. And this is a very important lesson for your retirement portfolios, because you want to manage a retirement portfolio which will give you an average return of what, 8%, 8 to 9%. 9% is pushing too high. If you get 7%, 8%, that's good enough with relatively low risk. So here's what we were just discussing. What is the rationale behind it? So you have the standard deviation to your portfolio. These are the number of stocks. Starting out with one stock, you get about 35% risk. As you keep adding stocks to your portfolio, you are reducing the risk. What you can do is you can reduce the diversifiable risk, which is the firm level risk. The market risk cannot be diversified, which is this 20% risk. What is market risk? Which is going to be impacting all assets in the market. But like we just discussed, you can further bring it down by investing in international markets. Because this market risk is pertaining to US market. You can even bring it down by looking at investing in other world markets. But can you bring it to zero? No, because as world markets converge or they have this globalization, this market risk factor will keep increasing. So you can see that at about 20 different stocks in your portfolio, the advantage has almost gone away. So rule of thumb is maybe having a maximum of 20 different stocks in your portfolio. But that's when you have a good investment to begin with. Good cash to begin with, which on average is about. What do you recommend to your investors? How much should they have in one trade? How much money?
In one trade?
One stock in one position.
No more than 5%.
But in amount of at least the minimum. Because remember, you got transaction costs of buying in and selling and maintenance. So the minimum which is recommended is at least $2,000. If you're not invested $2,000 in a position, there's no point, because you will lose out on transaction costs.
Because of all the costs.
Yes, buying and selling.
Okay.
And the rule of thumb for investing in different assets is you shouldn't have more than 20% in one type of asset. Anything more than that, you're putting yourself at risk. I mean, these are general rules. Don't go out and start buying or selling based on my recommendation. So and tomorrow you come and sue me or something. It's just what it's worked for generally many people. So, but again, disclaimer: my words in the class remain in the class. Okay, so the standalone risk is equal to the market risk plus diversifiable risk. Market risk is a part of a security which standalone risk that cannot be eliminated by diversification because it is impacting the entire market. Firm-specific or diversifiable risk is that part of security standalone risk that can be eliminated with diversification. So you should take advantage of eliminating the diversifiable risk if you can. So conclusion: as more stocks are added, each new stock has a smaller risk, reducing the impact on portfolio because of that marginal impact, which is going to get lower and lower. And the market portfolio risk falls very slowly after 40 stocks are included. The lower limit for market portfolio is about 20%, which is this market portfolio. That's the reason why nowadays, individual investments are losing favor with general investors. I'm not talking about, traders and speculators, but if you talk about individual investors, one good route is just invest in mutual funds, which will give you that benefit of portfolio. What is mutual fund? Mutual fund is several of those investments combined as a portfolio, and you're buying part of that portfolio. So you're already getting a diversified investment. You don't have to go and buy 500 stocks for S&P 500. That's already been done. You can buy a part of that portfolio by investing in that. So your investment will get about the same return as the market will get. That is what, anybody asks me, I will just recommend just don't even look at individual stocks, just go and invest in mutual funds or electronic traded funds, even for lower transaction costs. And they've got thousands of different types of options nowadays, in mutual funds. Yes, you have a question?
I was just saying, that's where a lot of these portfolio managers run into problems. They have so much money to manage, and they can only diversify away so much.
Yeah, right.
It's like they're buying the market with big funds.
Exactly. I mean, if you really go into, they got fancy names for the portfolios, for the mutual funds, but if you really go and look at individual investments that are there in these mutual funds, they're almost identical.
But you should find smaller funds that can allow them big ones that don't have so much money.
Right. The hard part is, looking through those, how many, about 5,000 different mutual funds?
More than that.
More than that. Somebody who has the time to go through all the 5,000 and see which ones is constructed how, and then be able to mix. So that's why, options, these mutual fund options coming from Vanguard, which have very low expense ratio, they're becoming very popular because one problem with the mutual funds is also the expense ratio that eats away into the profits. So all these things, students, I know all of you will start working, or some of you are working, would face when you start managing your retirement portfolio. So select the mutual funds where your expense ratios and other information is clearly defined. And one question you should ask your advisor is, would you invest in this mutual fund? And the second question is, how much of commission you're getting for recommending this mutual fund? And that will give you assurance of which mutual fund to pick in. So can an investor holding one stock earn return commensurate with its risk? The answer is no. Rational investors will minimize risk by holding portfolios. They bear only market risk, so prices and returns reflect this lower risk. The one stock investor bears higher standalone risk, so the return is less than that required by the risk. So we've discussed that. So how is market risk measured for individual securities? That we can do by calculating a stock's beta. Beta is nothing but what? It's the associative power of the stock with overall market portfolio. So market risk, which is relevant for stock held is well-diversified portfolios, is defined as contribution of a security to overall riskiness of the portfolio. It is measured by a stock's beta coefficient. For stock I, its beta is basically its correlation with the market divided by the standard deviation of the market. So correlation of the market multiplied with the standard deviation of the stock divided by the standard deviation of the market. And this can be calculated by regression analysis. So how are betas calculated? In addition to measuring a stock's contribution of a risk to a portfolio, beta also measures the stock's volatility relative to the market. So just a general question, what would it be better? If you were investing, would you look for higher betas or lower betas?
Low.
So again, it's preference. Do you want to really move with the market or not move with the market? Lower beta means it's not going to be as relative to the market. So using a regression to estimate beta, run a regression with returns on stock in question plotted on y-axis and the returns on the market portfolio plotted on the x-axis. The slope of the regression line, which measures relative volatility, is defined as a stock's beta coefficient, or B. And we got this data here, so I can demonstrate this. So we can take the year. This is the market portfolio return, and this is POU, PQU, some company PQU. That's for last 10 years. So this is 25.7. Then 8 minus 11, 15, 32.5, 13.7, 40, 10, negative 10.8, negative 13.1. And for PQU, it's 40 minus 15, minus 15, 45, 10, 30, 42, minus 10, minus 25, and then 25. So I think we can do it right here. Okay, this is 2013, so I haven't used, the graphs in 2013. Let me see. Select data. Let me just use this. Insert. We'll be getting this. Let me see if I can. This is the relational. Let me see if I can get the regression. We're getting the scatter plot. And all right, let me just do the I'll just use a regression function. Y.
Is there a proficient in Excel?
No, this is the new version, so it's in the 2007 one it was really intuitive. This one they changed a little bit. That's a dependent variable and this is the independent variable because I'm trying to see, and then we can just click OK. Yeah, now we get the same answer. So the couple of things that we want to look at is going to be your R square. I'll show you. And then there is the intercept. This one here. Which is 0.83, and then there is an error in the PowerPoint which is showing 0.0256, actually it's 2.56. So your return of PQU can be defined as a function of 2.56 plus a beta of 0.83 multiplied with whatever Rm. So let's say, so what does that mean? Let's say if the market portfolio were to increase by 1 point, what impact will it have on the return of PQU? It simply is going to be 0.83 multiplied with 1 plus the constant. Remember, constant is what? It's going to be the return of PQU even if market portfolio return is 0. That's a constant, right? Which is going to be this number here. So this will be 2.56 plus 0.83, 3.39. And I'll show you, this is 2.56, right? Constant. Market is 0.83. So remember that. And what is R square? R square is basically a number to provide confidence in your model, how credible the model is. The lower the R square, less reliable it is. So in this case, your model is correct 35.46 times, which is pretty low reliability. Normally you'd want 60 to 70% at least, to be providing some relationship between these two different type of assets. So it's not a very reliable model, but it's still giving you the information. So let's go back. Students online, is everyone clear with this? Again, I can show you, how to run the regression equation. Let me just show you again. So this is the data that I entered. What you do is you go to the data tab, click on data analysis, click on regression or analysis tool, and your input Y would be the dependent variable, that is the return of PQU is dependent on market return. So you take that as a dependent, and then X will be the independent, which is the market, and then you don't forget to click on label because the first cell is label, and then click output in a new worksheet, and then simply click OK, and there you get it. So let me show you the error where the PowerPoint has a typo or it's an error is here. So you can see that this is the same we got. We got the R square the same. You see this? 0.0256. That's a typo error. It should be 2.56. Actually not. My mistake. You know why? These are in returns. These are in percentage. So this is right because it will be divided by 100. So this is correct, because this is in percentage. What we calculated was in numbers. So the final result would have to be divided by 100, only for this part. But the main idea is to get, your correlation with the market portfolio. And that you can also get by, again, Excel is really good for all this. Let me show you. Another thing that you can do is just to get the correlation. And this is going to give you, the beta number is just take these two, click on data analysis, and then go to correlation, click OK. So PQU is correlated about 60% with the market portfolio. That is another way of looking at how well a stock is correlated to overall market. So this way you can say if it's well correlated or not. That's another way of looking at it. Because you're trying to find the correlation, right, of the market with the market portfolio. So several analysts will look at simply the correlation. Several investors will look at the beta. And beta is also available. It's if you remember. Students online, can you view the browser window that I'm sharing? Okay, it's not responding, but let me try. Okay, can you view the browser window now? All right, so let's take example of a Apple or Microsoft. So there you go. So it's got that data here. This is that beta number, not the constant. This is that beta. So this is basically an indicator of how likely the stock will move with the overall market movement. So if Dow Jones Industrial Average will move up by 1 point, Microsoft will have an impact of positive 0.85 approximately. But again, this is historic data, so we are assuming this based on historic data. Will it be in future? We don't know. Some people argue that it's still a relevant factor to look at. Some people say, some investors say no. Let's look at Walmart. Beta is 0.82437. I mean, this is debatable. I mean, I was assuming that it would be low beta because Walmart tends to do well when overall market is not performing that well. Because, customers are more conscious about spending when markets are not doing well. Let's look at Dollar General or Dollar Tree, Dollar General. Let's see. Actually, in Dollar Tree, beta is 1.036. It's very dependent on the market. Again, it kind of is counter. That's why I'm saying, analysts, if you talk to different investors, they'll give you a different reaction. I mean, looking at this, it doesn't make sense because Dollar Tree, Dollar General, they are counter moving stocks than the market. When the market is not doing well, these companies are supposed to do well. When the market is not doing well, when the market is doing well, these companies tend to do not so well because consumers shift their preferences over to different stores because then they get disposable income. I'm just trying to see if I can find a low beta stock.
Chevron.
Okay, Chevron. Actually, it's 1.12. So it's even more dependent on the market. But you can see, how easy it is to get that relationship by looking at just one number. That's why beta is so important.
Put your entry on here.
That company is out of existence, I think. Facebook is 83, 0.83. Let's see. I still remember the symbol. It's not even on the. It's in pink slip, like it's yeah. Let's see what else.
About
97.
Celgene or some biotech.
Pfizer. $1.07. Microsoft was the first one. Dell is not listed anymore. It's a private company. Let's see. HP. 1.89. That's even more. Let's look at Google, which is Alphabet now. That's a new name for the company. Alphabet, yeah. It's 1.03, so mostly all stocks are highly correlated. I can give this as a homework assignment. Find 3 stocks which are under 0.5. That's going to be a homework. One of the homework assignments. So the regression line and hence beta can be found using a calculator with regression function or spreadsheet program. In this example, beta was 0.83. This is the one that we're really interested in. That's the beta, the associative number. Calculating beta in practice, many analysts use the S&P 500 to find the market return. Why? Because it's a proxy. If you talk about market would then include all the stocks in the world, all the stocks, all the bonds in the market, all the other type of investments like arts, jewelry. Can you go and get exact value on everything in the market, selling in the market? It's impossible. So what we try to do is get a good proxy, which is like S&P 500, which is those 500 stocks combined in this index. Analysts typically use 4 or 5 years of monthly returns to establish the regression line. This can be another good paper. Some analysts use 52 weeks of weekly returns. How is beta interpreted? If beta is equal to 1, stock has average risk. If beta is greater than 1, stock is riskier than average. If beta is less than 1, stock is less risky than average. So what do you want to do? You want to pick betas which are less than 1, right? Most stocks have betas in the range of 0.5 to 1.5. Can a stock have a negative beta?
That one from the first example.
Have a negative rating for that.
Huh?
Have a negative rating for that. Correlation with it.
I mean, the negative correlations, right?
Yeah.
The one that's in that first example, the, I can't remember it now.
Yeah. Alta,
Yeah, alpha.
but in real world, I mean, again, it goes back to a debate of can any stock exist which is not affected by market.
Right.
That is the only way you will have a truly negative stock in existence, because it will be totally non-impacted by anything that's happening in the market.
You can have an exchange traded fund can have a negative beta. Some of these,
Well, give me an example. I mean, the lowest we've been able to get practically is a T-bill.
can you go back to that sharing, the Yahoo?
We'll probably do it. We leave it as a homework, you know, your interest in the class kind of a question. I'm going to leave this as a discussion post assignment, you know. So you can have other beta sites, you know, like I just showed you. Expected return versus market risk, which investment is best? You know, now you got risk or beta. You can see this. So use the securities market line to calculate each alternative's required return. And the way you do it is by taking the risk-free rate plus your market portfolio return multiplied with the beta, you know, of that investment. So assume that risk-free rate is 8%, that is a T-bill rate, and RM equals 15%. So RP, which is a return of portfolio, is RM minus the risk-free rate, which is 15% minus 8%, that's 7%. So this is, so in case of the required rate of return, you would want, in case of Alta, 8%, that you will get anyway by investing in what? T-bill. Plus the 7%, which is based on the risk, multiplied by its associative power with the market portfolio, and that's equal to 17%. So this is going to be the return that you will require for investing in this stock. Okay? And again, if you probably want to follow again, the way you calculate that would be to take your returns of the market portfolio minus the risk-free rate. So this is that extra return that you get, which is 15 minus 7, that's 7%. So this is the amount of extra return you're getting for taking the risk for investing in the market portfolio. So consequently, if you invest in Alta, you should get that much of return multiplied with the beta. That is the associated power of Alta with the market portfolio, plus the return that you will get in risk-free rate. Because this you should get anyway. I mean, even if you took no risk, you will get. So 17% is the return for Alta. For market is 15%, which is exactly going to be what it was, because 8% plus 7, because you're getting 7% here, right? See, this is return of market minus risk-free rate. So that's 7% you're getting for investing in market. So this is 8 plus 7, that's 15. AM foam 12.8, T-bill 8, because you're not going to get anything extra, and repo is 2. So this is the required rate of return based on the associative power of these investments with the market portfolio. So these are the required return, and what is the expected return? In case of Alta, it's 17.4, the required is 17, so currently it's undervalued in the market. Because you're getting more return than what you should. So consequently, it's undervalued. Market is fairly valued because it's the same. AM foam is again undervalued, T-bill is fairly valued, and repo is overvalued. So which should be your investment choices? Either Alta or AM foam, because they're undervalued. So you can see this now. This is the securities market line. AM foam is above the securities market line. Alta is above securities market line. So your choices should be either Alta or AM foam. And if you're holding repo, you should sell it. So you can extend that, by calculate beta for portfolio with 50% of Alta and 50% of repo. Again, the same concept. Take average of the betas, 1.29 plus 0.86 negative divided by 2, and that's equal to 0.22. So in this case, what have you done? You have basically reduced the beta with the market portfolio. Same thing as reducing the risk to your portfolio. Same concept. So the required return on Alta repo portfolio, 50% of 17% required for Alta, 50% and 2% required for repo, that's 9.5. So the required return for portfolio should be 9.5. So this is the original situation. Impact of inflation. Why has the securities market line gone up? Because of inflation. Because your required return would be 8% plus the 3% of inflation. Because your money invested today will lose a value of 3%, so you will require 3% more in investment. Impact of risk aversion. Risk aversion is what? Yeah, exactly. The propensity of an investor to avoid risk. So for example, if your original securities market line is this, and you want to avoid risk, you would command a higher return for the same amount of risk. Because on this line, 18% would have been somewhere here.
Can you do that?
Yeah, you can. I mean, you can basically just, you cannot do it immediately, otherwise everybody would be jumping and, jumping from, 15 to 18%. I would be calling my financial advisor every day, hey, jump me from 15 to 18%. But you can look for investments which are going to provide you with this lower coefficient of variation.
But doesn't that all still depend on the how volatile the stock market is?
Yes. Yes. So that would be shifting from your asset types. For example, if you have a volatile market situation, you would shift your investments from risky type assets to relatively more safer. But that means you will be lowering your expected return. So, or it could be currently, for example, if the market interest rates go up, you could move from your current stock investment portfolio over to bonds, because new bonds which will be issued, they'll be issued at a higher coupon paying rate. But the risk will be lower in case of bonds. So that would be an example, where your securities market line would look like this. So has CAPM been completely confirmed or refuted? No, that statistical tests are problems that make empirical verification or rejection virtually impossible. Investors' required returns are based on future risk, but betas are calculated based on historic risk. That's the historic data. That's the main problem with betas is it's calculated on historic data, whereas you're trying to assess volatility which is going to happen in future. Investors may be concerned about both standalone and market risk. So that brings us to end of chapter 6. Are there any questions at this point? Yes, go ahead.
With the version, I know the depending on how volatile the market is, but if people know about that, why did the stock market get so why did most investors seem to struggle with when the recession hit?
Can you repeat your question?
Why did a lot of investors get in trouble with their money when the recession hit again in the early going in the mid-2000s? They're trying to avert the risk.
In early 2000.
Well, like 2008.
In 2008.
2008, when the recession started to hit us really bad.
So why did people lose their money in the portfolio? Is that what you're asking?
Yeah, you didn't all this calculation. He's trying to say, even after doing all these calculations, why do people lose their money? Right.
Because of uncertainty in the market, which cannot be predicted at times. There are certain uncertainties in the market which can be predicted, like volatility. Looking at volatilities of a market, it's like a case. For example, let me give you a very simple example. Let's say a credit history of a person. Now that is based on historic information, but it's a general indicator of how that person will treat his or her credit in future, right? So for example, if I have a very high credit score, now does it warrant that I'm going to be a good, credit,
History tells us that.
kind of a sort of a managing customer in future? Let's say if I take a 30-year mortgage, can you predict if I'll be consistently paying for next 30 years? No. But history tells us that it will be the case. Same thing.
That would be like if the bank, you defaulting on your
Yeah.
loan, and you say, well, why did the bank not know that? They didn't. They only could go by.
They could only go by so much of information. So same thing for econometric modeling. When you look at a company's stock, that's why I'm saying returns are not that important when you're trying to forecast. It's the volatility.
Oh, okay.
How volatile the stocks are. So for example, if you are invested in a company which has been very volatile in its stock performance historically, those companies will be more prone to negative shocks or volatile shocks during uncertain events. And companies which are more stable, they can last through. I mean, they will have a negative impact, but they will last through. And again, coming to your point about people who lost money, like I said, people who lost money, if you go and look at their portfolio, they were not well diversified. The problem with our financial industry is most of the financial advisors, they are not well trained in these statistical concepts. So they're just going by A, either what's been told to them, and B, sometimes personal preferences or sort of favors that companies provide. For example, they'll provide them with extra commission. You sell our product and we'll give you that extra commission.
And that's why you said we should have to be getting the commission on that.
Exactly. Are they getting commission for this? Or if they were to invest, would they invest in this?
And people didn't realize how risk averse they really are.
Exactly, yeah.
They think they want risk until
They really, and if you look at the historic, let me show you a very interesting thing, and it's a good point. I think all of you should really be. I think you should. I think I should be. I don't want to advise anything when it comes to investment, but I think I should make you aware. Let's look at Dow Jones Industrial Average. Dow Jones. Students online, can you view the browser window that I'm sharing? So let's look at a graph from the maximum time period. So look at this. Look at this graph. What is this graph showing? On average, what's happening to overall market? Let's say if this is your retirement portfolio, you start saving money. Let's say even if it's 2,000, right? And you are putting money away and putting money away. There have been drops. Look at this. There have been one drop here, which was following the 9/11, and then this significant drop right after the subprime mortgage crisis. But overall, what's happening to the market? It's going up. So if you can sustain those small drops or even significant period drops, overall you'll be fine. I mean, even though this is like a 50% drop almost, you picked it up. This would have been a very good period to buy stocks. But then it's nerve, investors, are they going to start to panic and start selling everything here? Or will they just keep their investment? People who did keep their investments and kept investing regularly, they ended up making 30-40% returns on their portfolio. Investors who sold everything right here thinking, well, the market is just going to crash, obviously they lose money. So that's why, historic data analysis is very crucial. It's important to understand. But one thing that you have to look at is overall, the market has been consistently going up. And this is just, coming from 1987, but most, primary level investment textbooks will have a very nice graph in the very first chapter giving this index from 1900 all the way up to 2010-12. And that shows, a dollar invested in 1900 has grown to almost $1,100. So that is the growth in the market. As long as the market will sustain, your portfolio will sustain. But I'm not advising anything. I'm just giving you information. So I hope that answers your question. Any other questions, students online? But it's a very important thing to go back and revisit your investment portfolios if you have one. And if you don't, then something to think about when you start building your retirement portfolio, investment portfolio. But like anything, it's a little bit of gamble. If you don't want gamble, just invest in T-bills. All right, then. That's all for the class this evening, then. I think we're finished with Chapter 6. I'm going to post an assignment associated with Chapter 6. I did post assignments associated with Chapter 4 and 5. I've given you until November 27th, 29th, I think. I'm sorry. Did I give October or November? Yeah, okay. I'm just thinking. My brain is tired. So is mine, Deborah. I was hoping to just stop when we finished the, that risk, the coefficient of variation. I so much wanted to end there, but I thought, I have to finish this chapter because I'm not feeling too well either. But thank you all for being so patient, and I'll see you next week. Thank you.